Common Sense on Mutual Funds by John C. Bogle. This episode covers the book Common Sense on Mutual Funds by John Bogle, a legendary American mutual fund industry figure. Among all investment books, Common Sense on Mutual Funds is likely the most relevant to ordinary investors. The author describes a simple, long-term, and easy-to-learn investment strategy in this book. A century of data in the American market has proven this strategy effective over the long term, yielding returns that far exceed fixed deposits. What is this magical strategy? Let me give you an analogy.
Imagine you have a hobby of rolling snowballs. When it snows heavily in winter, you find a long slope with wet snow. You start by making a small snowball with your hands and slowly pushing it down the hill. As it rolls, the snowball continuously gathers new snow, becoming bigger and bigger. This process of moving a snowball is akin to investing. When you invest in the stock of a good listed company, like Kwaichow Matai, it's like entrusting the company to roll the snowball for you, growing your principal larger and larger. But how do you pick which company has the best snowball rolling ability? This selection process is highly professional. Moreover, each company's ability to roll snowballs changes constantly. A company might be great last year, but less this year. If you delegate to a company, you must continuously monitor and keep track of it, which is time-consuming and exhausting for most people. At this point, someone offers a straightforward solution: create a plan that helps you select hundreds of relatively reliable companies to roll the snowball for you. If some companies fall behind, they are periodically replaced with new ones. So, you need to entrust the snowball rolling to this plan without worrying about the rest. Each company here represents a listed company's stock, and this plan that selects hundreds of companies is called an index fund.
When you buy an index fund, you simultaneously entrust hundreds of listed companies to roll the snowball for you. Since this method seems effortless and requires no active intervention after purchase, this strategy of buying and holding index funds is called passive investing. The author of this book, John Bogle, was the first to invent index funds. This tool provides an excellent investment method for ordinary investors. He received many honors throughout his life. Even Warren Buffett praised him highly. At the 2017 Berkshire Hathaway shareholders meeting, Buffett greatly praised John Bogle. Buffett said, "John Bogle has done more for American investors than anyone else, maybe more than anyone ever will." When Bogle first started offering index funds, hardly anyone on Wall Street wanted to help because index funds lowered investment fees, reducing Wall Street's profits. Today, index funds bring higher returns to investors than almost any other financial product. This book, written specifically for the public by John Bogle, is his most classic work. Using a wealth of convincing data and evidence, it comprehensively explains Bogle's core investment philosophy. In the following sections, I will summarize the book into 3 parts. The first part will explain why passive investing has advantages and how to engage in passive investing. The second part will discuss what kind of self-discipline a qualified mutual fund investor should possess. The third part will explore how Bogle's investment philosophy. Now, let's move into the first part, why passive investing has advantages and how to engage in passive investing. Earlier, we introduced passive investing briefly using the snowball analogy. Let's explore it in more detail. Investments can be divided into 2 types, active investing and passive investing. Active investing involves conducting your research, selecting stocks you believe are reasonable, choosing the correct times to buy and sell. This process requires making many active decisions, hence the name active investing. Warren Buffett is a representative figure of this method. In contrast, passive investing involves neither selecting stocks nor timing the market. It uses the most straightforward method, buying a basket of stocks and holding them for years or even decades without making changes. Despite its seemingly foolish simplicity, the author John Bogle tells us that this approach can outperform most professional fund managers. So, what should one buy for passive investing? John Bogle recommends buying index funds. First, explain the concept of mutual funds in the book title. Mutual funds are funds that raise money publicly from society to invest in securities, futures, bonds, and other financial instruments. Public funds can be divided into various categories, with index funds being one of them. In the U.S., index funds account for 1/3 of the total scale of public funds. Next, what does the index in index funds mean? A third-party institution usually calculates a stock market index using a simple mathematical method. For example, the S&P 500 index in the U.S. A-shares market is well known. It selects 500 stocks with good performance and large market capitalization from over thousands of stocks and calculates a stock index using a weighted average method. By observing the rise and fall of the S&P 500 index, you can get a general idea of the overall performance of the market on that day. If you buy a basket of stocks according to the proportions in the CSI 300 index, it would be equivalent to an index fund. Since this investment method doesn't require stock selection and can be done with a single purchase, index funds have become the primary tool for passive investing. What are the benefits of using index funds for passive investing? Bogle points out several significant advantages. Let's examine them one by one. First, high long-term returns. Over the long term, stocks have the highest long-term returns of all asset classes, including bonds and gold. In the past 200 years in the U.S., the long-term annualized return on stocks has been about 7%. This return rate is twice as high as that of bonds and significantly higher than that of gold, whose long-term return is almost negligible. Why do stocks have the highest investment returns? John Bogle provides a formula for the sources of stock returns. He believes that, in the long run, stock returns come from two things combined. The first is the dividend yield at the time of purchase, which reflects the company's ability to pay dividends. The second is the future earnings growth rate of the company you bought. We know that listed companies are typically among the best in a country's economic system, and their average earnings growth rate exceeds the country's overall economic growth rate. So, as long as a country's economy is on an upward trajectory, buying and holding listed companies over the long term will yield good returns. Besides long-term returns, John Bogle identifies two other major benefits of passive investing: low costs and the lack of need to time the market. Regarding low costs, let's look at an example. Suppose you have two investment options. Plan A involves buying an existing fund that allocates 35% of its assets to U.S. bonds and 65% to U.S. S&P 500 stocks. Plan B involves still investing 35% in U.S. bonds and 65% in U.S. S&P 500 stocks, but instead of buying the existing fund, you buy a bond index fund and an S&P 500 index fund separately. The actual investments are the same, but the index fund fees are slightly cheaper, saving you 0.9% in annual costs. If you invested $10,000 in each plan in 1947, 50 years later, Plan A would have grown to $1.08 million. Plan B, however, would have grown to $1.615 million, almost half more than Plan A. Since the investments in both plans are essentially the same, the significant difference in results is entirely due to the slight annual fee difference of 0.9%. This example demonstrates that reducing costs is a crucial measure in long-term investing. John Bogle even considers lowering costs the number one factor because any slight cost difference will be magnified over time. After discussing the advantage of low costs, let's look at the third advantage of passive investing, the benefit of not needing to time the market. Not needing to time the market is easy to understand because an index fund holds stocks in the same proportions as the index and does not sell them, eliminating the need for timing decisions. But is timing the market not an advantage? Let's consider it from the opposite perspective. Is timing the market an advantage or a disadvantage? The book examines the market timing abilities of the media, fund managers, and ordinary investors, finding that most of their timing attempts result in losses rather than gains. Therefore, not timing the market turns out to be an advantage. Let's start with the media's timing.
The book cites examples from two top American magazines. On August 13, 1979, Businessweek published a cover story titled The Death of Equities. Judging by the title, it was bearish on stocks. At the time of publication, the Dow Jones Index was at 840 points, nearly at its bottom. By May 1983, the market had risen by almost 50%. Another story is even more astonishing. The September 26, 1988 issue of Time magazine featured a cover story titled, Buy Stocks? No way. With a giant bear on the cover, the Dow Jones Index was around 2,000 points when this article was published. From that point, the index rose, eventually reaching 9,000 points. If even top magazines can't get it right, how can smaller media outlets? Bogle concludes that the media's timing could be more reliable. What about professional fund managers? What are their market timing abilities? One objective measure of fund managers' diligence in timing the market is the turnover rate, which indicates the frequency of buying and selling stocks. The higher the turnover rate, the more actively the fund manager engages in timing the market. From the 1940s to the 1960s, the average annual turnover rate for American equity fund managers was 17%, which isn't high. This means it would take over 5 years on average to completely change their portfolio. By 1997, the turnover rate had risen to 85%. Another decade later, in 2007, it had risen to 105%, meaning the entire portfolio would be changed in less than a year on average.
The data shows that American fund managers have become increasingly active in market timing over the decades, with more frequent trading. But the results? Unfortunately, there is no evidence that the management level of American equity funds improved with increased turnover. On the contrary, the higher costs associated with increased turnover hurt fund performance. Lastly, let's look at ordinary mutual fund investors' market timing abilities. Many retail investors try to time their purchases and redemptions of funds, a practice common in both China and the US. So, what does the American data tell us? Over 24 consecutive quarters, from 1975 to the first quarter of 1981, investors continuously withdrew funds from mutual funds, removing about half of the initial scale. After many people withdrew their funds, a new bull market began. The market started to warm up in the third quarter of 1982 and reached its peak in 1987. In the first 9 months of 1987 alone, investors poured $28 billion into mutual funds. Unfortunately, the stock market crashed in October. Next, we will move on to the second part: what self-discipline should a qualified fund investor possess? In this book, John Bogle provides several rules and suggestions for fund investors, which I have summarized into the self-discipline of a fund investor. You must have at least 3 qualities to be a qualified fund investor. The first quality: don't be swayed by a fund's past performance. If you conduct a small survey and ask people what basis they use to buy a fund, the answer you'll likely get is that this fund performed very well last year or that the fund manager is very famous. Historical performance and the reputation of the fund manager are the indicators most commonly considered by retail investors when buying a fund. Fund sales agencies also emphasize these aspects during the sales process. However, John Bogle clearly states in this book, do not overestimate the importance of a fund's past performance and be especially cautious of star fund managers. The book cites detailed research data. First, funds were divided into 4 groups based on their performance in the 1970s. Then, their performance in the following decade, the 1980s, was examined. It was found that the group of funds that performed best in the 1970s had an average annual return that was 4.8 percentage points higher than the index. Still, in the 1980s, they underperformed the benchmark by 1 percentage point, showing a clear mean reversion pattern. In other words, the better the past performance, the worse the future performance. This pattern repeated itself from the 1980s to the 1990s and from the 1990s to 2009. Since relying solely on a fund's past performance is unreliable, how should we choose a fund? John Bogle believes making decisions based solely on a fund's historical performance could be more reliable. However, historical performance is sound, we should use it to evaluate the fund manager's consistency and risk. Consistency has two meanings: whether the fund manager's actions match their words. The fund is untrustworthy if a fund manager claims to be a value investor but buys stocks of poor quality companies. Consistency also means whether the investment style remains stable over time. If a fund alternates between buying large and small cap stocks, its performance should be questioned. Risk refers to the volatility of the fund's historical performance and its ability to control risk when the fund's value falls from a peak. The second quality of a qualified fund investor is understanding the inverse relationship between fund size and performance. Fund size is an easily overlooked but significant factor. There is a saying in the fund industry: size is the enemy of performance. The larger the size, the harder it is to achieve returns that exceed the market average. Occasionally, top-rated funds in the market have an initial issuance scale of several hundred billion yuan. However, history shows that the performance of these funds could be better. Therefore, be cautious with particularly large popular funds. Additionally, John Bogle believes that it is unnecessary for ordinary people to buy too many different funds. Remember the one-hand rule: holding 5 funds is enough, and even 2 to 3 are sufficient. The third quality of a fund investor is having a long-term investment plan. Different indices correspond to other index funds. When investing, is there a difference in choosing different indices? John Bogle's answer is that there is a difference in the short term, but in the long term, there is almost no difference. He conducted a study on 2 typical indices in the U.S. market: the S&P 500 index, which represents large stocks, and the Wilshire 5000 index, which represents small stocks. Although there are differences in their performance over short periods of 3 to 5 years, over a long period of 30 years starting from 1970, the total returns of the 2 indices were consistent. Both achieved an annual return of 13.7%. Part 3. The first edition of this book was published in 1999, and the version we are discussing is the 2009 10th anniversary edition. The author included many events in the 10 years following the first publication in this edition. Since the reissue of this book, another 10 years have passed, and many significant developments have occurred regarding passive investing and index funds. Index funds have become more widely known in the last 10 years and are increasingly used by ordinary investors. In the United States, the last decade has seen a boom in the development of index funds, with their scale increasing each year. By the end of 2017, index funds accounted for more than 1/3 of the total $18.7 trillion in mutual funds. All of this began with the creation of the first index fund by John Bogle, the author of this book, in 1975. In the decades following that day, people discovered that index funds allowed every ordinary person to invest easily and share in a country's long-term economic growth. As a result, index funds have gained increasing popularity. Investing through index funds, in addition to the 3 significant advantages of passive investing that we discussed earlier, has 2 essential benefits that Bogle did not mention but are worth noting. The first additional advantage is that index funds do not rely on any star fund managers. The goal of an index fund is to achieve the same investment return as the stock index, so it does not require human intelligence to select stocks or time the market. It only needs to periodically adjust according to changes in the index components, making it minimally dependent on individuals. Changing a fund manager midway does not affect the performance of an index fund. If you plan to invest for more than 10 years, this stability, which is not dependent on individuals, is essential. The second advantage is that index funds inherently contain an investment philosophy of buying more of the good companies. The method of compiling stock indices usually involves market capitalization weighting. It means that the larger a company's market capitalization, the higher its weight in the index, and correspondingly, the more shares the index fund buys of that company. For example, in early 2009, the market capitalization of the Dow Jones Industrial Average was about $3 trillion. By early 2019, its market capitalization had grown to around $7 trillion, an increase of about 2 times. This effect occurs because the method of compiling indices inherently incorporates the principle of survival of the fittest, enabling index funds to buy more shares of high-quality companies. We have discussed that index funds have two additional advantages in addition to the three main advantages mentioned in the book. They do not rely on individuals and inherently follow a survival of the fittest investment philosophy. You are already more knowledgeable than most by understanding these two additional advantages.